Talking about the commodity space. We have Mark Keenan, Head of Commodities Research, Asia Societe Generale, joining in this morning. Mark, hi, good to see you in today. NYMEX, it's now at almost 6.5-year lows. Brent crude is now seems to be comfortably trading below $50 per barrel. What's happening in terms of the production as well as the supply situation globally for Brent crude especially, and how much lower do you think it can go and where do you think it can average?
Yes, good morning. Last month, the month of July, was a very bad month for the asset class as a whole, with nearly every single commodity falling by significant amounts. The only commodity that was up was lean hogs. Oil was specifically impacted by a fresh bout of news out of OPEC for the first time in quite some months, announcing a significant increase in production, specifically from Saudi Arabia and Iraq. And the reason why this was so important and why it had such a negative impact on prices is that the markets had largely been focusing on the growth in the shale production out of the US for the most part of this year. And it has become progressively more complicated to try and unravel how the rig count numbers have been matching up with production numbers. So when we had this very clear sign that OPEC production is really taking off, despite these low prices, it was taken very negatively. That, combined with a rising dollar, pessimism out of China, weighed across the entire asset class in terms of sentiment and in terms of price. Where are we going to go? We have a period ahead of us, which is traditionally a seasonally weak period, lasting through until October. This is the refinery maintenance period. We expect prices to remain soft and to possibly move lower during this time, but the good news with that is that Q4 and Q1 of 2016, we expect oil, both of them, WTI and Brent, to be significantly higher than we are now. So this forthcoming period might be a very good time to ease into a position, a long position, slowly, to try and build an average entry price with a view of exiting that towards the end of the year.
Mark, hi, good morning. So a slightly longer term question then. This is of course for the short term. Do you think OPEC has now really lost the pricing power completely? Because that was one debate which was doing the round for last 2 or 3 months, that it's North America now which has pricing power. And in that case, should we be prepared to see $40, $50 crude as normal, more than aberration?
The first part of your question, yes, I think that for the most part, and certainly to what we've been used to, OPEC has lost its importance in the market. It's very similar to 1985 when the North Sea oil production came into world markets and OPEC took a bit of a step back in terms of its importance and clout in regulating prices. Going forward, the US, or the most expensive production now of any meaningful volume, is US shale, and that will largely be the new swing producer and pricing mechanism for the foreseeable future. It makes sense. This is how commodity markets should work. OPEC and the region are very low-cost producers, and they should not be controlling the market price in terms of restricting supply when you have such significant sources of oil coming on stream in other parts of the world. So it will be different. This volatility that we're seeing now is really the world getting used to how the US is going to take that place as a key regulator of global oil prices. And until that becomes clearer, we can expect these gyrations and these headline-driven moves to continue for the short term.
So at the end of the year, Mark, where do you see Brent crude prices?
For Q4, we see both of them up about $6 or $7 from where we are now, and then Brent averaging about $60 for 2016. So just sub 60 for the end of the year, about $6 above the forward curve. So despite the very steep contango that often precludes long-only investments from generating the returns that you would think would be implied by flat price movements, there is quite some value in it. So around 6 to 7 by Q4, and then possibly $7 to $8 for the average of next year.
Okay. Mark, what about gold? Because, for last 6 months to 1 year, all we've heard is the demise of gold as safe haven. It's showing signs of life now for last 2 weeks or so. What's your call on the precious metals?
Yes, pathetic signs of life, as usual, with gold. Its ability to respond to traditional periods where a safe haven would be used over the last year, even longer than that, has continued to disappoint market participants, and it's not for lack of any degree of diversity in terms of things that it should respond to. If you remember, going back last year, we had a number of things. We had almost a war between Russia and Ukraine. We had crises in Greece resurfacing. We had ISIS. We had emerging market issues. We had many things, and during this time, gold did nothing. It fell 10% last year, and we had pockets of strength, 2% perhaps, and it was very quickly sold, and it's very swiftly moved lower. We see this exactly the same situation. We've had a little bit of a move up on the currency devaluation in China, but in large part it's viewed as a selling opportunity. We suggest selling it. If you're holding gold, get out of it. If you can go short gold, go short gold. If you can't go short gold, then go short silver as a proxy for that. And prices will continue to fall. They'll fall to $1,050 in Q4 of this year, and they'll average around $1,000 next year.
Okay.
So overall, a very bearish outlook.
Extremely bearish outlook. I'm sure a lot of Indian consumers would be happy with that bearish outlook. They just run to the jewelry stores and buy some more gold. But
you'd think that.
Mark, what about copper? It was at a 6-year low last week. It's recovered a little bit. Where do you see it go, especially maybe in terms of the uncertainty on how much the PBOC could do in order to shore up its exports and its growth?
Well, the thing with copper is that it sits slightly apart from the rest of the base metals, insofar as it is currently trading now, despite being at a 6-year low, significantly above its reported cost of production, its 90th percentile cost floor, as it's referred to. Some $1,000 above that at the moment. So it is very vulnerable to retracements. In addition to that, recently this year, weakness in producer currencies, for example, the Chilean peso, where about 30% of copper comes from Chile. That is down about 15% against the dollar year to date. And about 70% of mining costs are domiciled in local currency. In addition, oil has declined, as we've discussed, which has also reduced mining costs. So there's absolutely no threat for miners to rein in supply in any capacity, or at least what the reported cost floors might suggest would happen. So it's very vulnerable to further downside. The slowdown in China, the wobble with the currency has affected it, has affected the sentiment. So where do we go from here? I think, mindful of the cost floor argument, we see prices over the medium to long term higher than we are now. So this is into next year, the end of next year, back up towards 5,900 and then over 6,000 as supply growth starts to decline and as global demand increases in accordance and in alignment with the recovery in the global economy. But at the moment, it's precariously balanced, and we suggest, in fact, not getting involved in copper in terms of the industrial metal sector, but rather focusing on the slightly smaller metals like zinc, metals like lead, nickel, tin. They provide a very interesting entry point at these levels, and they're either in situations that have very tight supply-demand dynamics currently, or are forecast to do so going forward, and they're not as vulnerable to this cost floor argument.
Okay, all right, Mark. We'll have to leave it on that note, but thank you very much.